Good day. This is the Eye of the Storm podcast for Sunday, April 10th, 2022. Welcome. I am Michael Filighera, and I will be presenting today's podcast. And today I'm going to be talking about my big picture update for gold and silver. So as you can see, I'm starting here on my gold futures on my preferred view. And as an Elliottian, I tend to run two scenarios, my preferred view and the alternate view, which just kind of protects against sudden moves in either direction. I work on my preferred view because that's what I believe the market is telling me, but I also have my alternate view, which would include a reverse, let's say, and why the market may just drift down or drift up, et cetera, et cetera. So for those that have been trading gold for a long period of time, you likely already know many of the triggers that bring in buyers and sellers in gold. But right now, we've got several in play. We have geopolitical differences primarily with the Russian invasion of the Ukraine, which has an effect on gold prices. We have here in the United States, the necessity that the Fed needs to jump on board and taking care of inflation. Another nasty market that can definitely have an impact on the price of gold and silver. When we combine these two, against the dollar, against pricing, against reserve currencies, et cetera, we can now build a picture of what the Elliott wave is telling us and what Fibonacci also in conjunction tells us about the possible movements here in gold. So again, I'm going to start on this long-term picture, the big picture. And right now, I am now pulling all the data that I'm capable of pulling through my Thinkorswim. And right now, so it's my monthly maximum. And right now, that goes back to January the 1st, 1975. And so I'm taking it from actually this low up to the all-time high that was reached back in 1980. At 870, let me just get that absolutely correct. Come on, get right there. 873 was the high for gold in the months of January in 1980. Also at that time, the United States was experiencing some very strong inflation where interest rates had been held low, and the market had revisited a couple of times during the 70s, some high inflation, some recession periods, and in an overall corrective phase, a long-term corrective phase for the equity markets really took place between the beginning of the 70s to about 74, all the way out to 78. Some analysts have pegged that at. Also, what we saw in the 70s was the first oil shock, the first oil embargo, the first time that oil prices in the United States just skyrocketed almost overnight. And if you were alive and well in the 70s and driving an automobile, back in those days, just about anything you bought was 8 cylinders and had a lot of pickup and go, and basically what would be considered a gas guzzling machine. We didn't have any of the environmental controls on what that engine was spewing out into the atmosphere. There was a lot going on at that time, and that would be basically pushing for change. And what we saw was that gold was reacting to interest rates, was reacting to inflation, was reacting to some uncertainty that was going on. And at the same time, there was another group led by the Hunt brothers at the time, and they attempted to corner the silver market. and along with it, forced to short in gold as well as silver, and then getting caught in that game and the market totally reversing off of those lows and actually going not all the way down to pre-Bretton Woods, but nonetheless did come down off of those highs. Also within the 70s, we did have the major policy change that then President Nixon put into place, and that was taking the US dollar off of the gold standard. And he did that through Bretton Woods, and that happened in 1973, whereby the US dollar would no longer be backed or pegged by gold, and which meant that gold can free flow. So we have to consider that this 1975, so this happened in 1973, we kind of came down. But once gold can just go wherever it wanted to go, it did. It did. And it just rallied while the dollar just puked and died and went crazy and went in every other direction. Now, what then took place is by uncoupling gold, we went to what is now known as the fiat currency, where the United States dollar is backed by the good faith and credit of the United States Treasury, the United States government. And that has now been pretty much just not sustainable. And so part of what we're seeing is how other countries, other major players on the global economic plane are beginning to acquire quite the hoard or the stash of gold. And I'm going to start this part of the conversation and I know that it's not really going to be chart related, but I'm going to give you a lot of background in here. In that, while Russia has invaded the Ukraine, prior to that, Russia had been building up its gold reserves. And part of how they've done it now, because after the invasion of the Ukraine, massive sanctions have been put on Russia, the Russian central bank, the SWIFT, which allows Russian banks to come into for SWIFT transactions between rubles and dollars and yuan and all the different currencies, participating payment systems. That's all been now closed down to Russia. And so initially that created a situation where the Russian ruble collapsed and lost most of its value, if not all. But at the same time, that even though Western sanctions have frozen a chunk of the country's foreign exchange reserves after they invaded the Ukraine, that Putin and his regime has about $140 billion of gold that is beyond any of the reach of sanctions. $140 billion in gold reserves. So now what Putin has been doing is kind of tying up the defenses against economic restrictions. He's been doing this for a long time by building up his gold reserves. Now, one thing that we have noticed in the last week or so is how the Russian market, which had been closed for quite some time because of the invasion, reopened, rallied strongly. The Russian ruble is almost back to where it was prior to the invasion, prior to sanctions. Suddenly the Russian ruble has value. And the thought behind that is that Russia is now starting to back the ruble with gold. And being as it is that gold is priced in dollars for the most part, and oil is for sure priced in dollars, which continues to show the dominance that the United States has had over global international trade, particularly through agreements that were made back in the 70s, where the United States, in negotiations with OPEC and basically Saudi Arabia, got them on board to trade oil in US dollars, which then forced all of the oil producing countries to bolster the reserves of US dollars so that they could trade in the open market in oil. And that also then presented a challenge because now they could trade in the open market in gold with their US dollar reserves. So all of these countries had to really pick up their US dollar reserves and build them back up. Well, including Russia, including China, who have outside plans for possibly what they're going to be doing. So Russia's gold holdings have basically since 2014, which is when they went in and without firing a shot, annexed Crimea as a part of Russia. And that happened in 2014. Since that time, Russia's gold holdings have tripled. And this has now triggered US sanctions. So if we take a look at what the White House has made official statements about, that they really kind of estimate that the gold bullion makes up of about 20% of the country's central bank's overall reserves. So these numbers are changing quite a bit. And that's actually going to be putting a lot of pressure on gold because the demand for gold is increasing. So now I just kind of want to also bring in, okay, so now let's go back to our preferred view. Again, long-term chart, multi-year chart. So this, when I'm doing Elliott wave, and we're using it on a commodity or a precious metal, one of the observations that Elliott himself made was that the highest degree that remains consistent to count within a commodity or precious metal market is cycle. So I do not go above the cycle degree. So when we finish a cycle degree 5-wave advance, then yes, we're going to likely have a cycle degree 3-wave decline in correction, but the cycle starts over. The cycle starts over. It's not like I'm building up, and when I finish a 5-wave cycle up and then a 3-wave cycle corrective phase down, that in turn completes wave 1 and 2 or higher of a super cycle degree, and then conversely up into a grand super cycle degree. So we do not go above, or I do not go above, cycle degree within gold, silver, and other commodity markets. So within the precious metals, in fact, all of them if I'm doing them, but in gold and silver in particular, I do not go above a cycle level. So that's the biggest cycle that the precious metals will put in before you start a new cycle. So right now, I am counting that high in 1980 as the high of cycle wave 3. And then I do a large ABC, which took us down to the lows at 253. And that was in August of September, October of 1999. And this was also going right into that period where the European Central Bank had been formed, and then all of the member states were working to equate their currencies to the eventual switch, which happened at the turn of the millennium, where we went from, say, Dutch guilders, Deutschmarks, Swiss, not the Swiss franc, the Belgian currency, Ireland, a lot of the member states overnight had to switch from their currency to a 1-to-1, and this happened to euros. And so gold, in the meantime, in preparation of that, many of the same member states had taken on the stance that the United States did back in 1973, and they gave up backing the currency in gold and let it free float in more of a fiat currency. And that really put such a spin on things at the time, where we saw currencies get annihilated by the market, to the point where those countries, and particularly I'm thinking of Sweden, England, Ireland, the Netherlands, Germany, Spain, France, where they would come in and manipulate and sell hard these currencies because they were free floating now, they were fiat. And to the point where the Swedish central bank had to raise their overnight rate, what they were willing to pay banks who were dumping Swedish krona into the central bank, 500%. Where in England, that overnight rate got to 25. In Ireland, I believe, if my memory serves me right, it got to 100%, 100% overnight. It was incredible. And this was changing dramatically every single day as the Forex markets would choose a new currency. The Irish punt was demolished. And what effect that has on the Irish economy and the Irish, everything that gets connected, interest rates. It was quite the affair. But gold, in the meantime, we had central banks selling their gold holdings, which essentially drove the market all the way down to its low at 253. That low was in August of 1999. And from that level is where I have marked cycle wave 4, an A, a B, and a C. And so it is from that level, 1999. So this current move, this current run has been in force for almost 21 years. Excuse me, almost 22 years. Whew, got a little bit off on that one. 22 to 23 years, depending on the date that we want to use. If we're using August of 1999 or July of 1999, then in July of this year, it's going to be it'll be 22 years, almost 23 years. So this has been already in progress, and we've only finished primary wave 1 and primary wave 2. Now, the other thing that R.N. Elliott himself noted about the commodities and precious metals versus equities. In an equity market, it is wave 3 that will be the longest and the strongest and build power that we just don't see anywhere else in its formation, in its run. Where in commodities, it is wave 5 that is normally the longest and the strongest of 1, 3, and 5. And the reason most of that takes place is because it's during that wave 5 that news or whatever is happening within that particular market is getting the force to blast in the direction of the trend. And right now, that in gold, that trend is now up. And in essence, it has been up all along. When we have waves 1, 3, and now 5 are all rallies. Now, when I'm now counting a cycle degree 5th wave, within that are going to be 5 waves of primary degree. Those are labeled in the green. So these were primary degree moves within the cycle wave 4. This is the primary degree moves within the 5-wave advance that will be labeled cycle wave 5. So we have primary 1 and primary 2. Now, primary 1 brought us up to the September, I believe it was actually August. What was it? September? It was September. So in September of 2011, gold got up to $1,923, almost $24. And that was pretty amazing at the time, because we all believed that gold was surely going to go above 2,000 and just keep on going, et cetera, et cetera. And it hit the skids and it turned lower. And it actually from 1,923 dropped down to 1,046. And that took place over the next 3 years. So we can already determine that the impulse wave, which started in 1999 and finished its first leg in 2011, was basically 12 years. 12 years in the making. Then we have a 4-year correction, which fits perfectly because it's really 3.5 to 4. And that was just the wave 2 correction, an ABC. Now we're beginning the 3rd wave. Now, the 3rd wave, if we were standing inside of commodity, an equity market, we would be determining that it's the longest and the strongest wave. Right now, it is not. It is definitely strong, and it's already produced 2 trips above 2,000. So it's doing its job. But within that primary 3rd wave, we have intermediate 1, 2, 3, and as best as I can put it out there, and again, this is the maximum monthly, I'll start to bring it down. I believe that we have finished intermediate wave 3 of primary wave 3, and now we're in the process of putting in an intermediate 4th wave, which I believe we still have a C wave down to do. That's not cast in stone. That's just my estimate of what my Elliott wave count is telling me. We have spaces in there, and I'll go over that in a moment. I just wanted to lay out this maximum monthly picture as we start to develop where are we going next and how high or low can the market go. But now I want to just fill in some additional blanks of what's going, I think of what can be going on in with gold and what can really be affecting it. So again, Russia has really bolstered and raised their gold reserves. So the amount of gold being held in Russia. Russia is also accepting the sanctions have clamped down the export of Russian oil. But Putin is walking around that, and he has found some buyers within the Middle East who are willing to buy his cheap oil and pay him in gold. So it's shifting from oil in dollars to gold in dollars and shipping that gold back to Russia and getting around sanctions. Now, whether that's still successful, yet to be seen. I have not been reading anything like U.S. is sanctioning even harder because of, et cetera, or they have managed to figure out how. Now, the real question does come down to the United States has to prove that without a reasonable doubt that this type of trade is taking place so that they can go in and sanction that actual transaction. That takes a lot more time. So it's still taking place. So if we take a look at as well, if you remember, there was a lot of talk, there's a lot of discussion that Vladimir Putin and Xi from China have been talking often, talking a lot And a lot of it was felt that China was giving Russia support for invading the Ukraine. And then, of course, the Chinese government was issuing statements, no, we're not supporting their invasion of a sovereign country. And how much we want to really adhere to that or not depends on which conspiracy theorist you're actually listening to. Because I think that China may have given the Russia to China, China to Russia nod, like, sure, go, okay, you're going to go do that. We're not going to try to stop you or talk you out of it, because if we turn and we go and invade Taiwan, which China believes is their sovereign property, that's part of the Chinese mainland and not a separate country called Taiwan. So if they decide it's time and they're going to go over and they're just going to militarily invade Taiwan and take it over and push it back to being a part of China. We know that China is setting up a lot of military bases. They're building the islands to set up military bases in the South China Sea. So we have all of that brewing and the brouhaha. But here's one that is actually, I think, makes more sense to our dollar, to the bond market, and to gold and silver. And that is that China as well has been building their gold reserves, and their longer term plan is they want to get the currency of trade. So for gold and for oil. So they're starting with the petrodollar, the petro groups that all have accepted for the last, this also happened in the 70s. So we're talking that maybe 35, 40 years where this has been, actually a little bit more, that this has been in play for let's say 45 years, at least, where OPEC has been using the dollar, which forced all of those central banks to bolster their dollar reserves and to buy US debt. So it was a great move by the United States to gain superiority and economically around the globe. So much so that now we have two other major superpowers, whether we think we can knock them down, cap it off at the knees, whatever you want to call it, yet to be seen, because their plan, as best as I can interpret, for Russia and for China, is who's going to win that battle to make the petro yuan or the petro ruble as the trade instrument for oil. I know China would love to see it as the yuan. China would also like to see the yuan as the international currency of choice to price gold. Now, this could be in an effort, of course, that they want to regain the dominance and actually kind of knock down or knock out the United States from that lofty position it has held since the end of World War II. And it may happen. So these are the things that are kind of rolling around. They don't happen overnight. They have been in progress for umpteen years. They're just doing it very quietly and behind the scenes. And as things come out, we get written stories about it. We do find things about what is happening. So now I want to add one additional thing. First thing I'm going to do is I'm going to talk about gold reserves as of May of 2021. So we don't have the latest figures, but I want to just say, as of May of 2021, the United States was and still maintains the first position in, first of all, the number of tons of gold we hold in reserves. And so we still are the largest holder of gold, with our official gold reserves at approximately 8,134 tons. Now, what we need to understand is that gold, 1 ton of gold, so just to kind of put this around it, is that 1 ton of gold is equal to 32,150, or actually you could say 151 troy ounces of gold bullion. 1 ton of gold is equal to 32,151 troy ounces of gold bullion. Okay, so now what we're looking at is this ranking. So the United States has 8,134 tons of gold. That's how much we hold. The percentage of foreign reserves is 77.5% for the United States. Of our foreign reserve is being held in gold. Germany is number 2 with 3,362 tons of gold, and that represents almost 75% of their foreign reserves. Italy is number 3, again, European Union countries. And it's interesting, very wealthy. So Italy is number 3 with 2,452 tons of gold, representing approximately 69% of its foreign reserves. France is number 4 at 2,436 tons of gold, roughly representing about 64.5% of France. The fifth largest holder of gold is Russia with 22%. Now, remember, since 2014, Russian reserves have tripled in 8 years. This is a slow process, but if they continue to go at this rate, in another 8 years, will they then have 50%? Will they have lowered the United States percentage? Will there be a case in our scenario where the United States is going to have to turn back to a gold standard to back our currency as a trading currency? These are what's happening behind the scenes. It isn't always about interest rates. It isn't always about what affects the rise and the fall of the dollar. What about our, foreign exchange? What about our, our international trade, et cetera, et cetera? Yes, it all has a part, but guess what? So does gold. And how much gold you hold, and you can back your world trade. This is now coming into play. So now, what is the 6th largest country? China. China's in there with, actually, their total percentage of the foreign reserves, it drops dramatically. So I just want to show you the drama with Russia picking up, tripling their foreign reserves in 8 years to 22%. China is only 3.3% of their foreign reserves are in gold, but they're building that. They're now taking gold, buying it and putting in reserve, buying it and putting in reserve. So there's this change that's going to be taking place. And as we see things start to come to a head, what do we now can kind of put into this gold picture and this gold picture that we're now demonstrating here? What's ahead for gold and what could propel it to these levels? All right, so now we've talked about the largest 6. And let me just add this. Number 7 is Switzerland, who everybody thought, well, you hold the world's reserves because you've been a neutral country during all the wars that we've had around our globe on a world basis. No, Switzerland only has 5.4% of foreign reserves are in gold. They only hold 1,040 tons of gold. So they don't hold the majority anymore. They're number 7, and Japan is number 8. India, which is now talking with Russia, doesn't want to be on Russia's bad side. Why? India has an appetite for gold, they always have. The average Indian citizen will go out and buy gold jewelry. They will buy solid gold. They don't buy, the fake or the plated. They're buying jewelry that is gold-based. So these continue to grow. So the Netherlands is 10th. So the top 10 are United States, Germany, Italy, France, Russia, China, Switzerland, Japan, India, the Netherlands. The European Central Bank is number 12. So 1, 2, 3, 4 of its, Switzerland actually is not a member state, but within the European Union, 3 members are 2, 3, and 4. And you wouldn't think about it because the United Kingdom is 18. So this kind of tells you, as much as we went Bretton Woods on everybody, our gold holdings remain up at the top. Now that you would think continues to be supportive of the dollar, unless everything changes hands. And what I mean by that is what happens. Now, I've already presented the stock market update and a long-term picture. We talked about interest rates in the long-term picture. We talked about how under current conditions, we live on very high inflation. That heavy, high inflation is dictating a lot of things. We cannot get around it. And we've had cheap money on tap since 2009. Actually before, but a major portion since 2009, when we had an economic collapse, when the federal government and the taxpayer had to refund banks, companies, Detroit, the automobile industry. We had to step in or GM was going down and Ford would have followed. So these things took place and they worked, but then we had a pandemic. And now we had to fund the citizens of the country to continue to participate in the economy of our country. Don't forget, we were sent home. We were locked down. We could not go out. People lost their jobs. Many still don't have their jobs. And there's a whole bunch of talk around that. But we're not going into any moral issues here. We're not going into, well, they could go back to work. It doesn't make any difference. Here's the reality. This is what happened. And it ends up being inflationary because what was the country's choice? And I don't really believe when it was made that we actually had any others, even though they fought it. But the people that had fought it so that the people that don't have didn't get any, because then the people that do have lose control. Now, no moral issues here, no nothing. We're just talking fact. And the fact is that the country dumped $6.4 trillion, went out and printed it, created it, and pushed it into the banking system and pushed it to all of us here in the United States. Corporate got a bunch of that money. And a lot of that ended up in the CEO's pocket and in this pocket and that pocket within those corporations. So all of us down below, we got stimulus checks. We got stimulus payments, like $600 to $1,200. If you had kids, it went up from there. Insurance had to be broadened, that we couldn't leave people without insurance in a pandemic. It was a disaster. It was a disaster all the way around. Now, did Wall Street recover from all of that? Sure they did, but on what basis? On what basis did all this take place? So again, we're not talking about the stock market, we're talking about gold. So in 2009, here's the economic collapse. Gold went down, but it just did not drop. Yes, it lost about 50% of its value, almost. But consider in the rally that's taken place, this was just a normal intermediate 3 and 4. This is a primary 3 and 4 in the equity markets. In the interest rate markets, I think it was even smaller of a reaction because of what had to happen to get us out of all of that. And then what had to happen as we went through March of 2020. Right there. Look at gold. 1450, 16, dropped $200. There was good reason, right? Now, all this money's been pumped into the economy. All this money has been bringing stuff back. Now, we're going to now talk about what's available. This is important. And so when we take a look at that, the latest data points that the mark of 200,000 tons, 200,000 tons of gold have been mined in the world up to and including 2020. So about 2/3 of that gold has been mined and processed since 1950. So a lot of activity. So there are just slightly more than 6 billion troy ounces, 6 billion troy ounces of gold above the ground. So in other words, it's been pulled from the ground, it's been processed, it's now been put into bars, it's been put into jewelry, it's been put into whatever they're going to make from that gold. They've refined it. It said that's above ground amongst all of us human beings. Now, 50% of it is in jewelry, with 40% of it followed by fine bullion. So when I talk about it, when you get a bar of gold, it's usually marked right on it that it's not 0.999 fine. It's refined down to being 0.999% pure gold. That's pretty good. So now within that 40%, governments hold about 1/2 of that investment grade gold bullion in the supply around the globe. And they're holding it in reserves. So the Chinese government, God bless them, it is the thought process behind it is that the Chinese government is currently underreporting their official gold reserves. So by a minimum of about 10,000 tons. So you could probably work that out to be that say that it's okay to assume that more than 1 in 5 troy ounces of all the physical gold ever mined is currently being saved by governments and their central bank partners today. So about 1 in 5 of the troy ounces that have ever been mined is being saved by governments. So that tells you that China ain't telling us the truth if we work out those numbers. So why do governments buy, own, and hold gold for the long term? It's really pretty simple, right? So if we're likely holding a minimum of some 10,000 tons, then all human-made currency proxies, right? Whatever backs your currency, it eventually just goes away and it becomes valueless. We've seen this happen. But gold never goes worthless. And so it never bankrupts. You can't bankrupt gold. And so it never becomes worthless. So the United States continues to be, by far, the country that is stockpiling the most gold reserves, regardless that we had a president who took us off of that standard in 1973 to allow gold to flow freely, because prior to that it was really pegged at $43 an ounce, 43. And they limited, you couldn't really go in and buy it because they bought it. We wanted it, it was going to cost you a whole lot more. Nonetheless, that the United States, of about June of 2021, we have, like I said, about 8,134 tons of gold. And we've already gone over the other 10: Germany, Italy, France, Russia, China, Switzerland, Japan, India, and the Netherlands. So according to the World Gold Council, who I do get a lot of information from, 47% of the above ground gold has been refined into jewelry. right? 21.6% reserves held by private investors. And 17.2% is by governments. And 14.2% is actually used in industrial production, basically electronics and some other stuff. So if you're wondering how much gold is left, estimate to be left to be mined, what's left in the ground, below ground, approximately 54,000 tons of gold. So what we can say then is there are about 2.5 billion ounces of gold bullion above the ground today around the world, in this world. So more than half of it is owned by governments and central banks. And many still are buying gold by merely creating their currency out of thin air, if you want to say so. The yuan, the ruble, if you back up by gold, you just start rolling the printing presses and put out more money. So now, one additional factor that I want to put into all of this is that if there is not much gold available, right? When we break it down, 200,000 tons has been mined and sits above ground. We've already broken that down into where that gold sits. So available besides governments, what did we say? About, oh, what did I say? I have to go back and look at it. 21.6, 42,619 tons of gold is owned by private investors. This is an important fact. They're long the gold. So when we start to look at all of this, and we're looking and we're now putting it into our gold prices here, we begin to look at and think, what could produce this? Now, there are several ways that they will tell us that we can participate and invest in gold without having to go spend. Currently, gold closed at, on Friday, the future closed at 1,950.40. So an ounce. And an ounce is a troy ounce is a lot of gold in between. It's about 100 ounces of gold to a troy ounce. So what do we have out there that people can actually put money in and participate in gold, but they've been misled just a little bit, okay? We have GLD, which is a gold ETF, electronically traded fund. Now, when this was started, it was considered that for every ounce that was being purchased and via options or just in this ETF, that the ETF owners or controllers of the ETF management would go out and back it. So it was being backed by gold. So if it came down to it and somebody was willing to exercise the ETF, what they owned, and take it in gold, that transaction could take place. Well, then we have derivatives. We have options on gold. We have options on GLD. We have options on silver. We have options on SLV, which is the silver ETF. There are a lot of different things that take place. Now, so one of the things that they will tell you about is that when you buy an ETF, what is the risk? What is the risk to that ETF? And part of it, they say, they define it as counterparty risk. So a counterparty risk is that the risk of the value of the collateral falls below the net asset value of the fund when the fund counterparty is in default. So the counterparty in the default will be the one who needs to supply the gold to fulfill the contract. So in order to get around this, a lot of promises have been made. So you're not really getting your gold. You're getting a promise of that. And this is producing an extremely dangerous situation, because now we're getting pressure where there are countries, i.e. Russia and China, who are beginning to take in gold and back their currency. So they put out more yuan, they increase the value of the yuan, they move out and they want to have the yuan be the accepted petrocurrency. Right now it is the US dollar. And trust me, in the past, people, in the past, Gulf War 1 and 2 was because we were getting messed around with somebody trying to switch what they would accept. They would accept, it's well known, and you can check it out. Saddam Hussein, before he was taken down, was saying to the world, I'll accept the Iraqi dinar for payment of oil. I said, wait a minute. That means you don't have that many dollar reserves, which you really can't get your hands on, because we, at the United States, slap sanctions on them. So he was just, well, I'll just go right to the gold. I'll just go right to the market. And I'll just accept, you buy my own currency, I'll accept it for payment of oil. What did we do? We went in and invaded the country. We took them down, right? Made an excuse, weapons of mass destruction. He's invaded Kuwait to take them over for their oil reserves, blah, blah, blah. More wars have been started and fought over oil than just about anything else. So, Gulf War, so it's there. Counterparty risk exists. So what are the balance of the risks if we're investing in a gold ETF? Well, number one reason for me is that you don't actually own gold. So the fact that investors don't even get to own any gold is just strange by strange. Wasn't that the whole purpose of the ETF? That I could purchase an ETF that is pegged to the price of gold. So price of gold goes up, GLD goes up. Price of gold goes down, GLD goes down. Well, now I can't even switch it out and take, when it goes up, say, I'm going to convert, here's some extra money. I want, whatever the contract value represents, 1 troy ounce, 100 troy ounces, whatever it represents, here's my money, I want my gold. Oh, we don't have it. We promise we'll give it to you, but we don't have it. So you got that. Since you won't actually gain ownership of physical gold with the type of ETF, a gold ETF, there are tons of ETF fees. And then you have the counterparty risks. And then, of course, you have the significant market risk just because of the movement in gold. So the biggest risk, the single risk in an ETF is, of course, the market risk. So like a mutual fund or a closed-end fund, ETFs are only an investment vehicle. It's a wrapper for their underlying investment. So if you buy an S&P 500 ETF and the S&P 500 goes down 50%, nothing about how cheap, tax, and efficient or transparent an ETF will help you. So S&P drops 50%, so will that ETF. We have the spiders, right? We have the spiders, tradable. they're discounted to the price of the S&P future and to the SPX, but the options are based on the SPX. So a lot of these things are tied together. But in gold, what happens if enough people that own the ETFs, that own the options, and they want delivery, they don't want dollars delivered, they want the gold delivered? What if something does come forward and starts to really shift gold being priced in dollars? What happens if the dollar falls strong enough because of a recession, because of other things? The world is changing, folks. So everything that I'm saying is out there. Doesn't mean it's going to happen tomorrow. Doesn't mean anything other than this is out there and this could happen. We basically sit on a powder keg in the gold and silver market should something force the market to jump back and actually take delivery of open contracts. We want the gold. There just isn't enough. We've allowed the derivative market to grow at such an accelerated rate that there's no way, there is not even enough gold available. I just went over all that. I just told you who has it, how much of it is of their foreign reserves. So that is going to tell you how much is actually backing their own currencies. Whether we think it's all fiat or not, they have to protect their currency, particularly the United States, because it is the international currency of trade for oil. It is basically the international currency of trade for gold that's being held in reserves. So we got a lot going on. Now, what happens if we get that big squeeze going on in gold? I think it could happen very easily. Now, I'm going to bring this down. So I'm giving you a lot of background on what the possibilities are happening in gold, okay? And how this picture has to continually swirl and what you have to continually consider when you're buying and selling gold. Now, if you're a long-term investor in gold and you're doing it as a storehouse of value, not a bad thought. Because as I've just demonstrated, while a currency can go to zero, hyperinflation can drive a currency to where basically it'll take you, let's just use it against the dollar. Maybe we have such a hyperinflation going on here, it'll take $400,000 to buy a loaf of bread. It's pretty much worthless currency because it's going to have to print so much that it just doesn't have any value. And if they have to keep printing dollars to feed debt, well, what do you think this does for the value of the dollar? When we put out 6.4 trillion of them just to keep the United States afloat during a global pandemic. Now we have to print out more because we have ignored our own infrastructure here in the United States, and a lot of it is in dire need of repair. Start over, tear it down and start over. Bridges, the electric grid, the water system, the gas grids, all of it. We have chosen not to pay any attention that it needs major upkeep. Bridges start to fall. We've seen, we've witnessed. They're used. You know, our interstate highways, they need repair, et cetera, et cetera, et cetera. The electric grid, ooh, serious trouble. Anyway, when all of this really starts to roll and really starts to affect, the currency can really go to worthless. Gold will not follow. And whether the price of gold goes tumbling down along with the currency, when it comes right down to it, if I hold $1 million worth of gold, but that gold does drop down to, you know, only being worth $500,000 worth of gold, but the currency is even lower, and maybe the currency no one wants. And I'm talking like very, 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 very dark days, but that's the basis of why many people will just hold gold because it will continue to have value. You'll be able to barter. You'll be able to buy things. But that's, a pretty dire picture. More to what's actually happening. My concern would be for a gold explosion to the upside in a short squeeze. There's a limited amount of gold actually available above ground, and there's even a smaller limited amount of gold remaining underground. But the cost of mining it and refining it far outweighs actually doing it, because the price of gold, when you're considering buying a mining company, you need to look at what does it cost that company to actually mine and refine an ounce of gold. That's a good one, because you're going to see that it values, it runs at different levels. You might find that Barrick is small, but Newmont is high, or a smaller, newer gold producer might cost them $1,750 an ounce to mine it and refine it. Where if it only takes Barrick or Newmont Mining $960 to mine it and refine it, you got a lot more room, you got a lot more play. Now add to this, we're going to have a short squeeze of just unbelievable short squeeze. If these contracts in these derivative products come to light and force the squeeze, we already know that there's not much of a supply available. So it's going to be harder to fill contracts. It's going to be harder to fill the demand will be much higher than the supply. What if you absolutely had to have gold? You're just, whoever you're dealing with, your clearing firm, your brokerage house, is like saying, we are going to do this and you're going to owe us, because they are liable and they're going to stop it. So they go out and buy gold. Now, how I've got this set up right now, let me go back to that monthly max chart. I've got a 1 and a 2, we're in a 3. And so what I've done is I've run Fibonacci extensions for a third wave, a primary third wave. Again, does not have to be the longest and the strongest, but let's just say that it equals wave 1. Let me bring this down because it's going to be a lot clearer if I'm not sitting up there on that whole thing. So I'm going to start to bring this down. So right now, 2007-14 or 2715 is approximately where intermediate wave 5 would be equal to intermediate wave 3. Now, I think if we really get into a squeeze, you've got people who are talking about, let's see if I can pull it up on this chart. They're talking about 3,000 in gold. And now I want to show you just on Fibonacci extensions. Let's just say that we're still thinking that the 5th wave, intermediate wave 5, is the one that'll blow the doors up of everything, because this is a precious metal. So if wave 1 is just normal, wave 3 may come in at the normal Fibonacci, which is 1.618 times the length of wave 1. That's 3,745. And it goes on. If this really gets into short squeezes, we got numbers up to the 5,000 mark. Does that mean it's going to happen tomorrow? No, absolutely not. But if it does start, and the gold you just see starts to jump and jump and jump and jump, it could be several players out there forcing the squeeze. We've already seen one where it went up to, let's see if I can pull this up. Right here. It went up to 2,089, and that was back in August of 2020. Okay. So then this is the breakout. This is like, okay, coronavirus isn't going to kill us all. We're not going to go broke, et cetera, et cetera. Now we're rising above. Look at that spike. That was a short squeeze. Somebody needed contracts because they had to make a delivery. And it ran all in 1 week. In fact, let me take it down to the daily, and it happened all in 2 days. Start to finish. This is where it started on the one day, 2006, and this is where it ended the next day, 1986, and it went down from there. Now, if that's just a B wave, we've already gone over where I think we have all this upside to contend with. If this is just a B wave, what am I talking? Well, we could probably come back down. If we got a C wave down, this is 1, maybe a 2, and we start to break. I'm thinking that we literally could come back down to 1668-ish, which is where the 200 sits. We would just need to get below there, which is 73, probably come back below, come drift a little bit below. I don't think that the market is really going to let this thing start dropping down to 1400 again. There's just too much pressure on the price of gold. There's too much pressure to own gold. There's too much pressure being exerted behind the scenes by China and Russia, and now India. So this is producing demand. And China and Russia have specific reasons. They want to bolster their economies and they want to bolster their currency. Okay, so now we have that. If it comes down, it could end in a failure. It could be a really quick drop and a pop and all of that. But that's if this count is correct. Otherwise, this is going to be wave 4. And now we're in that 5th wave. And if that's the case, if I have to put the B's all the way over here somewhere, and this is the 4, an intermediate 4, 1, 2, 1, 2, run, run, run. So I'm going to leave it like this for right now because we've not even gone back up to give it this another look. And that's what I would need to show that, okay, this is likely the 4. And then we still run that risk of a quick, because here's the other side of the story. There are enough of the larger players, a lot of large banks. Bank of America is in there with huge holdings or huge risk. JP Morgan, Goldman Sachs, Morgan Stanley. They all have a lot of risk, gold risk. So particularly JP Morgan, I'm pretty sure they're going to be right up there. So they try to hold it down to 1900, and you constantly see it's like goes back up to 50, then they start to hit it down, and ends up back down at 1900. That's the support zone, 1900 to 880. Gets down there, the strength to buy, they'll buy it right there, and I'll tell you what, I'm putting down my stick. If I'm buying a future, I'm going to take delivery. I'm going to supply the rest of the money, and I'm going to put up $180,000 or $190,000, and I'm buying a troy ounce of gold, and I'm putting it into my bank. Now, that's going to be a lot. So there's a lot of people that are willing to take it here and then likely take delivery. Now, it starts to fall. We have the 20 at 1883. We have the 50 at 1840. And then we have these other price points. But ultimately, if it breaks all that, I would anticipate that it does come back down here. And I think it would be quick because there's too much demand. Once, if indeed this is the 4 and we're in this wave up, I'm number one, it should be an easy shot. We got dang close in March that it zips above 2089. 2090, 2100. So once we get past this simple, which we came up and touched, we'll break it, we'll break that, we're headed to 2222. And then you've got your markers. This should provide a really fair amount of resistance to break through, but it depends on how strong. If the reason behind it is a squeeze, how strong it could be. Downside, there's too much interest in, we'll buy it because we're keeping it. So it's not like this is tradable where you're gonna buy it, but I may have to sell it cheaper. We got a lot of people that are going to be buying it because they're investors. We're buying it and we will take delivery of that gold. And so, and if enough of that comes through, folks, we're still going to get the same squeeze. Supply and demand. I don't want to settle it in dollars. I want to settle it in gold. So there's a lot that's going to be going on. So my longer term view in gold remains for it to go even higher, but depends on when. This is not going to happen overnight. It does actually been sitting in a box for quite some time right now. For a while, it's been sitting in this box. This is 2020. Yeah, here we are at 2022. 2 years later, we're still sitting in the same dang box, but we managed to get up towards the high. Now, what does that signify? Well, then we might just drop back to the low of the box, 16,075 to 16,084, right in there. We may just drop all the way back down and then run. There'll be a lot of trading in between here, by the way. But this is where I want to leave my gold and silver. I wanted to really make sure that we get a taste and we get an idea of what's happening behind the scenes and all of this stuff. It's a whole lot different than what's happening behind the scenes in an equity market, what's happening behind the scenes in an interest rate market, but they are intertwined. And what draws them all and brings them together? Currency, and above that, interest rates. Interest rates, and for us, it's interest rates against the dollar. And now we're in an international, self-made international disaster zone, basically. You know, with former presidents from way back wanting to have a one world order, a new system. You know, European Union, we have one central bank for all of our countries, blah, blah, blah. This has all been an exercise, folks, an exercise that we still don't have the results of. Now, quickly, because I've already been given a much, in silver, it pretty much is the same story, except not quite as, it's even more severe, okay? Here we have, this was the Hunt brothers back in 1980, running up the price of silver to $50.50. It's not been exceeded, but here we are. Cycle wave 3, cycle wave 4. Oh, and what a disaster, right? We went from $50 to $3.63. Wow. And then ran back in 2019, we got as high, 2011, excuse me, we got as high as $49.82. We were within 70 cents of reaching that all-time high. And what really squeezed this? Shorts. It was a short squeeze. And when that short squeeze got relieved, they killed it and brought it all the way back down to $11.64 before we started to rally again. Now, what do we do? 1, 2, 3, 4, 5. 5 waves. And there was your typical, there, folks, is your typical fifth wave in a precious metal. Look at what that thing did. Went from $8.77 to $49. That's a fifth wave. Now that actually just completed wave 1 of this cycle wave 5. Here's wave 2 of this cycle 5. So gold and silver remain in the same cycle move, but I think silver plays catch up with the price of gold. And so silver stands a chance that it could just wipe everyone off the map. Literally, I kid you not. If wave 3 is just equal to wave 1, that's $57.87, $57.58, $58. Clearly above all-time new highs. Then it still corrects, probably massively, and then it runs in that fifth wave. And that fifth wave, I am sure, will resemble these two. And I'm sure it'll be based on what will be fueling it is a very, very nasty short squeeze. So that's our picture for gold and silver. Patience is the game. A lot of intraday playing things of that, but I tend not to trade gold on an intraday basis. It's possible, and I think if I had enough requests of people who wanted to trade it, it's $10 in gold. It's $10 a tick. And so it's $100 a point. And right now, gold can move points quickly. In any case, this is where I'm going to end this for today. We've now talked about silver, we've talked about gold, and we've given you that big picture story. And if somebody were to contact me and say, I want a better detailed picture on silver, please let me know. I don't have a problem providing it, but right now, for the sake of time, I'm sure I've already gone over my 40-minute time limit that I want to keep these podcasts at. So I am going to finish it there. Questions? Leave them in the comment section. I love hearing from people, and I really like answering questions when I can. So gold and silver complete. So now we have part 3 done. Again, thank you for joining me today for this particular podcast, for listening to this particular podcast, and stay tuned. As I've said, over the next longer term here, I want to start bringing in other guests who might have a specialty in a certain style of trading or a certain market, and we can start to share trading and market tips with other people. So it should be getting interesting. Again, it's the Eye of the Storm podcast, and there'll be more to come. And again, thank you so much for listening. Have a great trading week.